Most people think required minimum distributions are simply a rule. You reach a certain age, the IRS tells you how much to withdraw, you pay some tax, and you move on. But that's rarely the end of the story, because one required withdrawal can affect multiple parts of your retirement income plan. Higher income taxes, potentially higher Medicare premiums, more of your Social Security benefits may become taxable, and in some cases, it can affect the long-term life of your retirement assets. This is what I call the RMD Domino effect. If you're approaching retirement, or you've already retired and have accumulated a meaningful amount in traditional retirement accounts, understanding this may help you avoid some unexpected surprises. And if, while you're watching this, you'd like a second opinion on how required minimum distributions may fit into your retirement plan, there's a link in the description below this video where you can schedule a complimentary conversation with me. Now, let's walk through exactly how this works. The first domino is the required minimum distribution itself. For decades, many people faithfully contributed to traditional IRAs and 401k plans because they received an upfront tax deduction. Taxes were generally deferred until later. The trade-off was simple, but eventually the tax bill comes due. Once you reach the age when required minimum distributions begin under current law, you're generally required to withdraw a minimum amount each year based on the IRS life expectancy tables. Whether you need that money or not doesn't matter. Whether the market is up or down doesn't matter. The withdrawal is generally required. Here's where many people stop thinking. They assume the tax impact ends there. But that may only be the beginning. The second domino is your taxable income. Every dollar withdrawn from a traditional retirement account is generally added to your taxable income unless special rules apply. Imagine two retirees. Both spend exactly the same amount every year. One receives most of their income from tax-diversified sources. The other has a large traditional IRA and must take significant required minimum distributions. Even though they spend the same amount, the second retiree may report substantially more taxable income simply because of those required withdrawals. And once taxable income increases, more dominoes may start to fall. The third domino is Medicare. Many retirees don't realize that Medicare Part B and Part D premiums may increase for higher income retirees. These income-related adjustments are generally based on your reported income from prior tax years. So, a larger withdrawal today may not only affect taxes this year, but it can also affect Medicare premiums in future years, depending on your overall situation. I've spoken with retirees who were surprised when they received a notice showing higher Medicare premiums. They assumed it was just another annual routine increase. In some cases, it was tied to income they had reported previously. They didn't realize one financial decision had created another financial consequence. Then comes the fourth domino, Social Security taxation. Many retirees believe Social Security is always tax-free. Others believe it's always fully taxable. Neither is necessarily true. Depending on your overall income, a portion of your Social Security benefits may become taxable under current tax rules. As required minimum distributions increase your taxable income, they can also increase how much of your Social Security benefits may be subject to federal income tax. So, the required minimum distribution isn't just creating taxes on the withdrawal itself. It may also increase taxes on other income sources that weren't previously taxable. This is why retirement planning isn't simply about investments. It's about how different sources of income work together. Here's another important point. Many people think the solution is simply withdrawing less. Unfortunately, required minimum distributions don't work that way. The IRS determines the minimum withdrawal amount. Ignoring it can result in penalties if the distribution isn't taken correctly. So the real question becomes this: can you prepare before required minimum distributions begin? In many cases, yes. That's where proactive planning often becomes valuable. For example, some retirees gradually reposition portions of their traditional retirement assets over time. Others carefully coordinate withdrawals before reaching the required minimum distribution age. Some evaluate Roth conversion strategies when appropriate. Others seek to build a more tax-diversified retirement income plan years before required minimum distributions ever begin. The key point is this: Many of these conversations are often most effective before required minimum distributions begin. Once they're already happening, some options may become more limited. This is exactly why I encourage people to begin planning several years before retirement or shortly after retirement instead of waiting until required minimum distributions begin. If you'd like to find out whether your current retirement plan may be affected by the RMD domino effect, there's a link below where you can schedule a complimentary retirement planning conversation. We'll help you better understand how your retirement income sources fit together and identify areas that may deserve a closer look. Now, there's one final domino that often never gets discussed: future taxes. Many retirees focus only on this year's tax bill, but retirement isn't one tax year. It may be 20 or 30 years of tax planning decisions. A decision that seems small today could create larger required minimum distributions later if account balances continue to grow. Likewise, delaying planning for several years may reduce the flexibility you have later on. That's why retirement tax planning isn't about finding a single solution. It's about making thoughtful decisions over time. One adjustment here, another adjustment there, small changes that may compound over many years. The good news is that the RMD domino effect isn't unavoidable. Understanding how these rules interact gives you the opportunity to plan ahead rather than simply react. Because the goal isn't just paying less tax in one particular year. It's building a retirement income strategy that considers taxes, Medicare, Social Security, investment risk, and long-term cash flow together. If you're nearing retirement or you've already retired and you'd like to better understand how required minimum distributions may affect your personal situation, we'd be happy to have that conversation. You can schedule a complimentary meeting using the link below. Thanks for watching, and I'll see you in the next video.